Today we will explore a classic paradox. What happens when an irresistible force meets an immovable object? As the paradox applies to the massive stimulus on the one hand and the unprecedented levels of debt that has built up in the U.S. economy and we're still adding to on the other hand. If the paradox is resolved, or if either one of those overpowers the other, there could be some interesting outcomes ranging from just extended economic weakness to normal economic recovery out of the recession that we've been to a currency crisis and high interest rates. As Sarah mentioned, Tom and I will split duty today, each taking one side of the paradox. I'll give you some foundation for the nature and the extent of the stimulus that we've seen, along with some of the preliminary outcomes, and then Tom will take you through the debt picture along with implications for the markets, and he'll close with a brief comment on current market conditions. So what I'd like to do is start today by looking at some of the events that led our government leaders and market watchers alike to conclude that we needed massive stimulus somewhere along the way. You have the booklets in front of you, and you might find them easier to see, or depending on where you're sitting, you might find it easier to look at the screen. Let me briefly describe what you're looking at, and I'll try to do that as we go through each of the charts, and Tom will do something similar. You're looking here at a tracing of the Standard & Poor's 500 stock index going back to January 1st of 2007. And it concludes as of Friday. We have to do some of this work before we actually show up here, you know, so we concluded this on Friday. And the reason why we took this back to January of 2007 is that that's when we actually started to see tremors. There was signs of weakness, in particular in housing, prior to that, but we started to see tremors in the marketplace starting in January of 2007. What we've done here is annotate basically each of the major moves down over the course of the last couple of years. And so in January of 2007, I remember I spent a fair amount of time absorbing what's going on in terms of news, market-related kinds of news, and I remember kind of sitting up in my chair when I noted that a mortgage company had failed. And the reason why I took special note of that was because I had the good fortune or misfortune, depending on perspective, of having been a banker, been involved in lending, and ran an organization as Arizona was going through its recession in the late 80s and early 90s, and the banks around us were, especially in Arizona, were collapsing. And so I was very familiar with some of the symptoms of overextension of credit, and I sat up and took note. And what happened in that period of time is that we saw a lot of mortgage companies starting to topple over. And there's an interesting little website that started up not too long after that called ml-implode.com, mortgage lender implode. Basically, it was tracking all the implosions of the mortgage lenders. And there have been several hundred of those. That's an active site still, by the way. By July of 2007, the hedge funds were starting to experience trouble, and there was a very sudden onset for them. They went from having maybe made a decent amount of money to losing a substantial amount of money. A number of them went belly up or needed rescuing from their sponsors in some cases that summer. And it was basically a liquidity crisis that was starting to take hold in the financial system. In the fourth quarter of 2007, Merrill Lynch announced for the third quarter a $5.5 billion loss, and then just a couple of weeks later revised that hugely down to $8.4 billion. There was a group of banks that talked about forming a consortium, not unlike what we saw with the Resolution Trust Corporation, whereby bad assets would be put into this consortium, and they later abandoned that in December or so. Another very interesting note that we saw announced in the fourth quarter of 2007 was that AIG had experienced a 27% decline in their net income for the third quarter of 2007. They announced that the decline was due to housing-related issues. This is what was in their press statement, including the fall of credit default swaps. And then there's a quote from an article that said, despite the trouble, AIG said it is highly unlikely, that was it, quotes from their press announcement, that it would be required to make payments on the derivatives. Curious that a year later the company was gone, essentially. Second quarter of 2008, we saw Countrywide, which was one of the largest mortgage lenders in the United States, get into serious trouble. IndyMac Bank, there were outright runs on the bank, and there were lines outside, just like what we saw during the Depression. And there was an article in July that announced that banks and brokers had lost, by that point, $485 billion. Third and fourth quarter of 2008, we saw a number of institutions go belly up or be taken over or be forced to change their charter in the case of the broker-dealers, for example. And then it sort of kind of last culmination that we would all say was sort of exciting, and there was a lot of drama associated with it, was heading down into the bottom in March. And that was really when the trouble with the consumer, it's not that it wasn't apparent before, but it really had taken root, and unemployment was accelerating, and the effects on global trade were becoming very apparent. And Tom's going to talk a little bit more about the consumer in his segment. In 2008, Mission and Marathon hosted its 25th annual investment conference that late April, and we had a guest speaker by the name of Charles Morris. He was an attorney and banker by background, and he joined us. We invited him to join us because he had just completed a book called The $1 Trillion Meltdown. He had already completed a great deal of research on it. He was intimately familiar with banking as an industry and investment banking, and he was one of the early commentators to really sound a strong alarm about the extent and the size of the crisis that we had entered. And so from our perspective, forewarned was forearmed for anybody that paid attention to what he had to say and to the messages that we had been sharing. These bullet points are some quotes from his book, and he clearly understands bankers and the profit motive when he says in that first bullet point, when money is free and lending is costless and riskless, the rational lender will keep on lending until there is no one else to lend to. And that's essentially what we've done. When we've gotten into all the subprime lending, we've been lending on credit cards to people that don't have the capacity to repay them. We've certainly gotten ourselves into trouble as an industry. He also correctly identified that the subprime problem would morph and really domino into other areas, whether it be credit cards or the commercial mortgage-backed securities. He knew one of the key changes that would have to take place, and that is that consumer lending or spending, must fall. And in fact, this will be a key factor in terms of how we recover, how fast we cut our spending, how fast we increase our savings, and that we do it at all. He estimated that losses due to default and write-downs would be over $1 billion. Since then, the U.S. Financial system banks and broker-dealers have taken losses of about $600 billion, as estimated by the International Monetary Fund, and they also estimate that another $400 billion still needs to be taken. He certainly forewarned about the additional losses that were coming in 2008. And then he wrote in early 2008 that pessimists have yet to be wrong in this cycle, and we would argue that it is still true. So given the liquidity issues, the accelerating loan losses, losses on credit default swaps, declining values in homes, and the weakness in the housing industry, given all of that, what that was going on, all these problems that we were seeing